Welcome back to the Deep Dive. Today, we're pulling back the curtain on one of the most iconic global brands. I mean, a company whose products touch billions of lives daily. You sent us this fascinating document, an SEC 10K filing from the Coca-Cola Company. Now, for those less familiar, a 10K is basically their big annual report. It's required by the SEC here in the U.S., and, well, it's just a goldmine of detail, isn't it?
It really is. And our mission, for this deep dive is to pull out the most important nuggets from this pretty intricate filing. We want to show you how a company of this scale actually operates, how it manages its incredibly complex global network, and how it navigates some pretty significant challenges. There's some surprising facts and I think moments of clarity here that go way beyond just, sipping a soda.
Okay, let's really get into this then. How vast is this company's reach? Like, really?
Yeah.
What were the key figures that jumped out at you from the filing about their global footprint?
Well, the first thing that just hits you is the sheer number of servings. Beverages with their trademarks account for 2.2 billion servings. That's out of an estimated 65 billion beverages consumed worldwide every single day.
Like 2.2 billion a day.
Every day. That's what, nearly 1 in every 30 drinks consumed globally?
Wow.
It just highlights the market dominance, but also the sheer logistical feat, right?
Yeah.
Distributing at that scale and maybe, how deeply ingrained these brands are in global habits, it's almost unparalleled.
2.2 billion, that's just mind-boggling. And they managed to get products into over 200 countries and territories. The filing shows their unit case volume actually grew too, right, from 33.3 billion in 2023 to 33.7 billion in 2024. And get this, sparkling soft drinks, their classic stuff, made up 69% of that worldwide volume, both years. What's also striking is trademark Coca-Cola, Coke, Diet Coke, Coke Zero Sugar. All those accounted for 47% of the worldwide unit case volume, still almost half.
And if you look geographically, it really underscores how global they are. The U.S. is, 16% of their worldwide unit case volume?
Right.
But a massive 84% comes from outside the U.S. You've got Mexico, China, Brazil, India. Just those four make up 33% of the worldwide volume.
Okay, so truly global.
Absolutely. And, what's really insightful about this huge scale is understanding the core business model behind it all. It's not just one thing. They basically have two main lines of operation. First, there's concentrate operations.
Okay.
This is where they sell the flavorings, the ingredients, the concentrates, and the syrups, including fountain syrups, to their authorized bottling partners. Now, these operations, they generally yield higher gross profit margins for Coke itself, but they result in lower net operating revenues reported on their books.
So it's about the secret formulas, the core IP, margin stuff.
Exactly. That's the heart of it. Then number two, you have finished product operations. This is where they sell the actual sparkling soft drinks, other finished beverages directly to retailers or to distributors and wholesalers.
Right, selling the cans and bottles themselves.
Yeah. And these operations, they typically generate higher net operating revenues for the company.
Makes sense.
But they come with lower gross profit margins.
So it's a balancing act.
It really is. This dual model lets them optimize both profit margins and revenue streams, Concentrate operations give them that high margin control over the core IP, the formulas, while finished product operations allow for crucial market penetration and direct revenue, especially in key areas. It's a strategic dance.
A dance between IP and market control.
Yeah, and few companies do it on this scale. And it's not just sodas anymore. The filing mentions Costa retail stores and their strategic expansion into alcohol in some markets.
Right, I saw.
And their operating structure is pretty sophisticated, too. You've got operating units focusing on regions, local execution, then global marketing category leadership teams. They handle innovation, marketing efficiency. And then corporate, doing strategy, governance, global services like consumer analytics, digital commerce. It's a well-oiled machine, really.
Okay, that structure makes sense for managing something so vast. And this brings us to something really crucial. You mentioned the Coca-Cola system. It's not just what's in the bottle, right? It's who puts it there and how it gets to you.
Exactly.
They rely on this huge network of independent bottling partners, distributors, wholesalers, retailers, alongside their own bottling operations sometimes. And they have this unique pricing model, the incidence-based concentrate pricing. Can you unpack that a bit?
Yeah, it's fascinating. Essentially, the price Coke charges the bottlers for that concentrate isn't fixed. It's actually influenced by things like the bottler's own pricing to their customers, the sales channels they use, even the mix of packages, cans versus bottles, different sizes.
So the bottler's choices affect Coke's price to them.
Correct. It reflects the shared value idea. It's almost like they're partners sharing in the final revenue stream. It links the bottler's success directly to Coke's pricing for the concentrate.
Ah, so it incentivizes the bottlers to grow sales profitably.
Precisely. Rather than just buying concentrate at a flat rate, it fosters, real alignment. But with a system this decentralized, that raises a big question. How do they manage relationships with so many independent companies, all with their own goals?
Yeah, that's a great question. And the filing gives us some clues. It details how they structure the bottler agreements. Outside the U.S., the agreements generally have a set duration. They can be terminated for specific reasons, and bottlers often get non-exclusive rights to make mountain syrups.
Okay.
But within the U.S., it's different. Most bottlers operate under a comprehensive beverage agreement, or CBA. These are 10-year terms, renewable. And they highlight these expanding participating bottlers, EPBs. They get exclusive territory rights, but also have specific performance targets they need to hit.
So more control and structure in the U.S. market.
Seems like it. And another key difference, in the U.S., the filing notes Coca-Cola generally makes the fountain syrups directly. The bottlers don't usually make those here.
Interesting. And this points to that broader strategy you mentioned earlier, refranchising.
Right, selling off their company-owned bottling operation.
Yeah. The idea is to let the main Coca-Cola Company focus more on the high-value stuff, brand building, marketing, innovation, new products.
And leave the bottling logistics to partners.
Exactly. And it seems to be working financially. The filing shows significant gains from selling off operations in the Philippines, India, Thailand, and selling an interest in Coke Consolidated, a big U.S. bottler. Over $1.7 billion in gains just in 2024 from these moves.
Wow, okay, so a clear strategy to streamline and focus on the brand.
Definitely.
All right, so beyond this huge network and business model, let's peel back another layer. What about the fundamentals? The building blocks, the people, what goes into a Coca-Cola product? Key raw materials must be huge.
Oh, absolutely. Sweeteners are obviously key: sucrose, high fructose corn syrup, but also a range of non-nutritive ones like aspartame, sucralose, stevia derivatives. Then fruit juices, particularly orange juice. They mentioned sourcing from Florida and Brazil. But they also flag challenges there: citrus greening disease, weather variability. It's a reminder of how fragile these global supply chains can be.
Yeah, good point. Nature plays a role.
And don't forget packaging. Key plastic, aluminum cans. They specifically note that some materials, especially aluminum cans, come from a limited number of suppliers.
Yeah.
That introduces its own risks, right?
Supply chain concentration, yeah. And all this is managed from their headquarters in Atlanta, Georgia, plus other facilities globally. It's just an immense logistical puzzle.
It really is. But, logistics only work because of the people. Beyond the syrups and bottles, the human element is absolutely crucial. Day-to-day execution depends on them. The workforce is massive, around 69,700 employees globally in 2024.
Although that's down a bit, right?
Yeah.
Because of the refranchising.
Exactly, down from previous years, and about 8,900 of those are in the U.S. They also mentioned some North American employees are covered by collective bargaining agreements, so organized labor is part of the picture. But beyond the numbers, they emphasize culture, a focus on inclusion, innovation, growth. They talk about fostering a growth mindset, encouraging employees to be curious, empowered, inclusive, agile.
Standard corporate speak, maybe, but important for a company this size.
I think so. And they back it up with programs. There's this Thrive Global Career Strategy program designed to clarify career paths, invest in talent development, provide learning online, through experience, even project opportunities via a Thrive Opportunity Marketplace. It shows they view their people as a strategic asset, something worth investing in.
Okay, makes sense. But every giant faces headwinds. What are the major challenges, the forces shaping Coca-Cola's future? Global economic conditions have got to be huge, right? Inflation, interest rates, recession fears.
It's definitely. Those impact affordability, consumer demand. When money's tight, people might trade down, choose lower-priced options, private labels. That hits Coke directly.
And the retail world itself is changing fast.
Right. Retail consolidation, fewer, bigger players. And the massive growth of e-commerce. That forces them to adapt marketing, distribution. How you buy a Coke is totally different now than it was 10, 20 years ago.
It's true. And operationally?
Always the concern around product safety, quality. They need rigorous standards, constant vigilance. and launching new things, like getting into alcohol.
Yeah.
That brings a whole new world of regulations, operational complexities they have to master.
Okay. But what about the really big regulatory and legal pressures? Those seem like major potential headwinds.
Yeah, you hit on a key point there. One of the most visible is plastics, increasing scrutiny over plastic bottles, packaging waste. The filing even mentions lawsuits by Baltimore and Los Angeles County over environmental impacts.
Seeking damages.
Damages and injunctive relief, yeah. And new laws, deposits, eco-taxes, maybe even bans on certain plastics could seriously increase costs or even hurt demand. And then there's climate change itself. Direct risk, rising temperatures, extreme weather. That could limit raw materials, like we said with orange juice.
Or increase costs.
Increase costs or even reduce demand in some cases. If you have unseasonably cold weather, maybe fewer people reach for a cold drink.
So it's not just reputation, it's direct financial and operational risk.
Absolutely. And then there's cybersecurity and data privacy, huge deal. They rely so heavily on IT systems. The threat of cyber attacks, data theft, viruses, ransomware, it's constant.
What are they doing about it?
They describe a multi-layered, proactive approach, aligning with the NIST cybersecurity framework, internal audits, external advisors, employee training on things like deepfakes, phishing. It's an ongoing battle.
Okay. But you mentioned one legal battle that sounded potentially massive financially, the IRS tax litigation.
Yeah, this one is significant. The IRS is after about $3.3 billion in additional U.S. federal income tax just for the years 2007 to 2009.
Okay.
The tax court mostly sided with the IRS, so the total liability for that period, including interest, came to $6.0 billion. And Coca-Cola actually paid that amount in September 2024, mainly to stop more interest piling up while they appeal.
$6 billion paid, but they're appealing.
Yes, they're appealing, and they state they believe it's more likely than not they'll ultimately win. However, and this is the kicker, if the court's reasoning were applied broadly to later years, 2010 through 2024, the potential future liability could be another $12 billion.
$12 billion on top of the $6 already paid.
Potentially. So, yeah, we're talking a possible $18 billion total hit. This isn't just a big number. It challenges their whole global tax strategy, especially around intellectual property. It could have ripple effects way beyond Coke.
Wow. A landmark case indeed.
And related to that, there are broader global tax policy changes happening. The OECD's Anti-Base Erosion and Profit Shifting Project, BEPS, Pillar 1 aims to reallocate some profits of large multinationals to where their customers are, not just where the company is based legally.
Okay.
And Pillar 2 is pushing for a global minimum corporate tax of 15%. Both of these represent a huge shift, adding complexity for global companies like Coca-Cola.
Yeah, global compliance sounds like a massive, constantly moving target. So let's shift to the numbers for 2024 itself. Beyond those huge potential charges, what did the financials actually show?
Well, net operating revenues actually got an 11% boost from price, product, and geographic mix.
So they were able to raise prices.
Yeah, driven partly by pricing initiatives. They specifically mention inflationary pricing in places like Turkey, Zimbabwe, Argentina, and also favorable product mix. This was despite them spending more on promotions.
Okay. But there were some big charges too, right?
Oh, yeah. Significant operating charges in 2024, over $3.1 billion related to the Fairlife acquisition. It's called remeasurement of contingent consideration. Basically, when they bought Fairlife, part of the deal depended on future performance. They've now had to adjust the estimated value of that future payout, leading to this big charge.
So an accounting adjustment from a past deal hitting current results.
Exactly. Shows how long these things can echo. Plus, there was a $760 million impairment charge for the body armor trademark in North America.
Writing down the value of that brand.
But on the positive side for net income, you had those gains from refranchising. We talked about Philippines, India, co-consolidated interest sale, and their effective tax rate for the year was 18.6%. That's influenced heavily by having so much business outside the U.S. and also by tax incentives in places like Brazil and Singapore.
Okay. So managing finances at this scale also involves internal policies. How do they think about allocating capital and governance?
They lay out clear capital allocation priorities. First, invest wisely back into the business. Second, grow the dividend for shareholders. Third, look for consumer-centric acquisitions. And then, if there's cash left over, share repurchases. For 2025, they're expecting about $2.2 billion in capital expenditures.
So investing, dividends, M&A, buybacks. Pretty standard framework.
Pretty standard, yeah. And on debt, they aim for prudent levels to keep borrowing costs down. Interestingly, the credit rating agencies, when they assess Coke's debt, also look at the financial health of some of their major bottling partners.
Because they're so intertwined.
Exactly. The health of the system matters. And finally, corporate governance, especially insider trading rules, is super detailed.
What stands out there?
Well, they have a global compliance policy. They define material non-public information very broadly. Big M&A deals, earnings results, cyber incidents, major lawsuits, basically anything an investor would care about. And it covers not just employees, but also related insiders, family members, people sharing a household.
Okay.
They explicitly ban things like short-selling Coke stock or pledging it as collateral for a loan.
Why ban pledging?
Because if the stock price drops, a forced sale could happen to cover the loan, potentially at a really bad time, maybe when the insider knows something negative. It avoids that pressure.
Right.
There are exceptions, of course, like for diversified mutual funds or regular 401k plan purchases.
Right.
They use trading windows, specific periods, usually after earnings are released when trading is generally allowed for insiders. And for those under the strictest rules, they can set up Rule 10b5-1 plans.
Ah, the pre-scheduled trading plans.
Exactly. You set up a plan to buy or sell shares in the future at a time when you don't have inside information. It provides a legal defense if the trade later happens when you do know something, because the plan was already in place. It's about pre-planning.
Mitigates the risk.
Right. And the penalties for breaking these rules are severe. Big civil fines up to 3 times the profit gained or loss avoided, plus potential firing. They take it very seriously.
So as you can clearly see, digging into an SEC filing like this, it's not just about dry numbers at all. It's really a window into the incredibly dynamic and complex world of a truly global company.
Absolutely. It reveals how all these pieces, financial health, operational strategy, legal compliance, the human element, have to intertwine. That's what allows a company like this to serve billions of drinks every day while also navigating these huge global challenges and, of course, opportunities.
So what really stands out to you from this deep dive? When you think about a company of this sheer scale, how do you think it balances that constant drive for innovation and growth with the increasing demands we see everywhere for transparency and social responsibility, especially in such a rapidly changing world, something to keep churning on?